In this video tutorial, we're going to look at the area of standard costing and variance analysis. To do that, we're going to work through a question called the Bright Paint Company. We will work through the question itself and the solution. A copy of the question can be downloaded from my website, danielkingaccounting.wordpress.com. It can be downloaded as a PDF. There are also links to other questions and other video solutions. So, moving ahead with the question, we'll start here at the top of the question. Reading down to the question, the Bright Paint Company produces product R, which is a unit 5-litre container of paint, standard cost as follows. So they produce tins of paint. The direct materials, 1.5 litres of the raw materials, or direct materials as I say, at €5 per litre, that's $7.50. Direct labour, 1 hour at €8 per hour. Variable overheads, €1.50. Fixed overheads, €2. Giving a total cost of €19. Now a little asterisk here on the fixed overheads. Fixed costs are budgeted to be 1.2 million per year or 100,000 per month. Based on an average monthly production of 50,000 units, this works out at a cost of €2 per unit. So that explains where the €2 comes from there. Moving on down to the next paragraph. The selling price is budgeted at €25 per 5-litre container, and the budget quantity to be produced and sold in each month is 50,000 containers. So the plan is to produce 50,000 containers. Variable overheads absorbed by labour hours. So variable overheads here are going to be linked directly to labour hours. And fixed overheads absorbed by units. So what we have now is the actual results. The actual results for the month of December were as follows. So we've 48,000 units produced and sold. Revenue 1,204,000, or 1,204,000. Direct materials, 372,300. Direct labour, 392,000. Variable overhead, 75,000. And the fixed overheads, 95,000. Gives a total cost of 934,300 and a profit figure of 269,700. Now, kind of look and see what we're asked to do. So, the requirements. A. Prepare a budgetary control statement in a marginal costing format showing the original fixed budget, the flexible budget, and the actual results, and also the variances. So we're going to prepare a table, and it's going to have one column for the fixed budget, second column for the flexible budget, a column for the actual results, and a column for the variances. So 4 columns there. And we've got that done. We're going to calculate the following sub-variances. The material price and usage, the labour rate and efficiency, and the variable overheads, expenditure and efficiency. And we've calculated all the variances. Part C, we're going to prepare a statement reconciling the original budgeted profit with the actual profit. Okay, so to start off with, we're going to produce this budgetary control statement. Now I'm going to put up a blank budgetary control statement. We'll just pull it up here. So here we have it here. So you can see you'll have your column for the fixed budget, you have a column for the flexible budget, you have a column for the actual results, and you have a column for the variances. And then down here we have the financial information in a marginal costing format. Sales less the variable costs gives the contribution, less the fixed costs gives the net profit. So we're going to fill in the information we need. Now, in the question we haven't actually been given the fixed budget, we've just been given sufficient information. So if we go back here, we can see there is the information regarding the costs. And here is the plan. They're going to produce 50,000 units. So what we do is we put in the information we need, and then we will construct the original fixed budget. So back to here. Now I've just inserted a little column here for units. So I'm going to put the unit revenue and costs in here. So for instance, from the question we can see that the selling price is budgeted to be €25. The direct material cost is budgeted to be $7.50. The direct labour cost per unit is budgeted to be €8, and the variable overhead unit is budgeted to be $1.50. Now just going back, we can see we're getting that information from here, given to us in the question. So back to my table here. So if I add all that up, that comes to €17, and that's the total variable cost. Now, it might be useful here to get the contribution per unit as well. So you'll have the selling price per unit, less the variable cost per unit, gives us the contribution per unit. Now remember, if you're working through this yourselves, you can pause, rewind, and play this video at any time. So continuing on with this, we note, if I just go back to the question again, that the plan was, here, just in the middle of this paragraph here, to produce 50,000 containers. So look at my table here. My original fixed budget is going to be based on 50,000 containers. Now, if the plan is to produce 50,000 containers and sell them for €25 each, that means we are actually budgeting a sales revenue of 1.25 million. For the materials, 50,000 by 750, that's 375,000. For the labour, 50,000 by 8, that is 400,000. And for the variable overheads, 50,000 by 150, that is 75,000. Now if I add these three together, I'll get my total variable cost, which come to 850,000. And I have my sales revenue minus my variable costs will give my contribution, my budgeted contribution of 400,000. Now my fixed overheads aren't unit costs, they're period costs, so what we need to find out is what was the budgeted fixed cost for the month per month. So if I go back here, we can see in this paragraph here, it says fixed costs are budgeted to be 1.2 million per year or 100,000 per month. So I'm going to put that in here. I'll put in 100,000. Now, actually I only have one fixed overhead here, one fixed cost, but sure, I'll add them up anyway, add it up, get a total there of 100,000. So what I have is 400,000 as a contribution, less the total fixed costs, gives me a profit of 300,000. Now do remember, when we're working through this, you can pause, rewind and play at any point. So what we've done here is we have reconstructed the original fixed budget. Now it's a little bit messy, so what I'm just going to do, I'm just going to tidy this up, tidy the figures there. So that's it. It's a little bit neater. So that's the fixed budget done. So what we'll do now is we move on and we put in the actual figures. So to put in the actual figures, I'm not actually going to calculate anything. I'm just going to go back to the question and see what are the actual figures. So just turning back to the question here, we can see down here, these are all the actual figures. So I'm going to put in the sales revenue, I'm going to put in the variable costs, group them together, and then I'm going to show the fixed costs. So I'm taking these figures here and just copying them into my table. So if I start at the top here, first thing to note is, let me just go back for 1 second, is that the sales were 48,000 units. So I'll put that in here. So the actual sales, 48,000 units. The actual revenue was 1,204,000. The materials came to 372,300. I'm just taking this straight from the question. The labour came to 392,000. And the variable overheads came to 75,000. So they're the actual figures. These three together, if I add them together, come to 839,300. Now that is my total variable cost. So I have my sales less my variable costs will give me my actual contribution, 364,700. Now the actual fixed costs, we note the fixed costs actually came in at 95,000. So I'll just put that in my total row here. So contribution minus my fixed costs gives me my actual profit of 269,700. Of course, that's what it had to be, because if I just turn back to the question here, we can see we're given the profit figure. Now, we're not putting anything new in. We're not taking anything out. We're just representing the information. So I have represented the information here, but of course, I had to end up with the exact same profit. Okay, what I'm going to do is I'm going to tidy this up as I did the previous time, but do remember, when we're working through this, you can pause, rewind, and play at any time. So there we go. That's it. Tidied up. So now we're going to put in the flexible budget. So the first thing is with the flexible budget is that the flexible budget is what we would have expected to happen given the actual level of activity. So there's the actual level of activity. So I'm going to put that in there, 48,000 units. So given the fact that 48,000 units actually sold, all other things being equal, what would I have expected to happen? Well, I would have expected them to sell for €25 each, so I would have expected sales revenue of 48,000 by 25 of 1,200,000. I would have expected the material cost to be 48,000 units by 750 per unit. That's 360,000. And then likewise for the direct labour and the variable overheads, 48,000 by 8, so I'd expect that to be 384,000. And 48,000 by 150 for the variable overheads, so I would have expected the variable overheads to be 72,000. Total variable overheads I would expect to come to 816,000, which would have given me a contribution of sales revenue minus variable costs of 384,000. Now, all things being equal, I would expect the fixed costs to remain the same. Fixed costs, by definition, should not be affected by changes in the level of activity, so the total fixed cost should have remained at 100,000, so therefore the profit should have been 284,000 even. Now what this basically means is we had an original budget profit of 300,000. Given the fact that the volume fell to 48,000 units, the profit should have dropped to 284,000. That's what we would have expected, but it fell further. It fell to 269,700. So the volume alone doesn't explain the drop. Something else has happened to cause the profit to go down to 269,700. So by analysing the variances, we're going to see, or we'll try and see, what actually went wrong. So what I'll do now is I'll calculate the variances. But before I do, I'll do what I've done before. I will tidy all this up. So let's tidy it up a bit. So now we're going to have a look at the variances. Now I'm going to go down through all these figures one by one, and I'm going to calculate the variances. So in other words, I'm going to compare these two here, and that will give me the sales price variance. So what I do is I will look at the difference, and the difference between those two is 4,000, 1,200,000, 1,204,000, and then I have to label this as either an adverse or a favourable variance. Well, that's what we would have expected. This is what actually happened, so in fact we're 4,000 better off, so therefore we have a favourable variance. Now moving on to look at the costs, the direct material cost. Well, we would have expected the figure to be 360,000. It in fact is higher. It's 372,300. That's a difference of 12,300. And we have a cost that is higher, so therefore that is an adverse variance. Direct labour, 384,000 is what we would have expected. 392 is the actual outcome. That's the difference of 8,000. And again, the actual figure is higher than the flex budget, so that's an adverse variance. And then finally on the variable cost variances, we would expect the variable overhead to be 72,000. They actually were 75,000. That's the difference of 3,000. And again, the actual results were higher than the flex budget, so that is an adverse variance. Okay, what we're going to do now is we're going to look at the contribution. You note that these are all cost variance or price variance. So this will be a sales price variance. This will be a material cost variance. This will be direct labour cost variance. And this will be the variable overhead cost variance. The thing about all these four here is that they're price or cost variances. We're comparing the flexible budget, which is based on 48,000, with the actual results based on 48,000 units. We're now going to look at the impact of the change in volume. So we're going to compare these two. So we're going to look at the original fixed budget, which was based on 50,000 units, but using the original budgeted prices and costs. We're going to compare it with the flexible budget, which is based on 48,000 units, but based on the same budgeted prices and costs. So the difference between the 400,000 here and the 384,000 here is being caused by the change in volume. So the figure there is 16,000. The contribution has fallen, so that's an adverse variance, and we could call that our sales margin volume variance. So up to here was all price or cost variances. Now we have a volume variance. And then the final one we're going to look at is the fixed overheads. I'm going to compare these two. This is a cost variance again. The difference there is 5,000. We would expect the fixed overheads to be 100,000. They in fact came in at 95,000. Costs have gone down, so that is a favourable variance. Now you could call this the fixed overhead cost variance. Okay, so there are our top line variances. So if I just tidy those up a little bit, that's what we have. And a little notation here. So price variance, cost variance, cost variance, cost variance, fixed overhead cost variance, and then this here is our volume variance. So what we're going to do now is we're going to take the variable cost variances, these three variances here, and we're going to analyze them a little bit further. So if we just go back and have a look at the question, we can see we're asked to analyze the variances, the material variances, into a price and usage variance, the labor variance into a rate and efficiency, and the variable overhead variance into an expenditure and efficiency variance. So that's what we're going to look at doing now. So I'm going to start off with the direct materials. So I'm going to take this and I'm going to divide it into a direct material price variance and direct material usage variance. So let's have a look at that. So starting off now, the material variances. So the material price variance. So it's a price variance. So what I'm going to do, I'll compare the actual price with the standard price. And then I'll multiply it by the actual quantity. So there's my little formula. Actual price, standard price, actual quantity. Now if we just check with the question here, back to where we were here, the direct materials are bought in litres. So the standard price will be this figure here. We expect to pay €5 per litre. The actual quantity of litres, we'll go down to the actual information here, 73,000 litres. The actual price per litre, well, we don't have that, but we can work it out. It actually will be €372,300 was paid for 73,000 litres. So with that information, we can work out the actual price, and that works out at €5.10. So what we have is an actual price per litre of €5.10, a standard price of €5, and 73,000 litres actually purchased. So that'll be a 10 cent per litre difference times 73,000 litres. So that works out at a €7,300 adverse material price variance. Now what we do is we look at the usage variance. So the material usage variance. So what I'm going to do here, I'm going to compare the actual quantity with the standard quantity, and I'll put into monetary terms at the standard price. So my little formula, actual quantity, standard price. Now if we just look up here, we can see there's the standard price. That's €5, so I'm going to use that there. There's the actual quantity, 73,000, so I'll put that there. So the piece of information I'm missing is the standard quantity. So we'll go back to the question here. Standard quantity will be based on the amount we should use to make a unit, which is 1.5 litres, times the number of units we actually made, which is 48,000 units. So therefore, we should have used 48,000 units, by 1.5 litres will be 72,000 litres. So if we go back and look at that, I put that in there. The standard quantity, 48,000 units, actually made. Each unit should use 1.5 litres, that's 72,000 litres. So you can see here what we have is, we have a standard usage of 72,000 litres, an actual usage of 73,000 litres, so we were inefficient in our use of materials, and we put into monetary terms at the standard price. So fill that in there. There is the actual quantity, the standard quantity, standard price. Now that is 5,000 adverse. Now I'm just going to take these two numbers here. So we have 7,300 adverse material price variance. We have €5,000 adverse material usage variance. So if I add those together, that gives a total of 12,300 material variance. If we just go back to the table, there we are there, 12,300 adverse, which is exactly what we have here. So we can take the total direct material cost variance, €12,300 adverse, and break it down into a price variance of 7,300 adverse and a usage variance of 5,000 adverse. And I need to work out the actual price as well. So what I'm going to do, I'm going to go back to the question and have a look at this. So moving back here, I'll have the standard price, €8. The actual price I have to work out, €392,000 paid for 49,000 hours, and the actual number of hours, 49,000. So the thing I need here then is the actual price, how much was actually paid. So if I pop that in there, we can see that works out at €8. Okay, this is a bit unusual here, because what has happened here is we have actual price €8, standard price €8, so we have a nil variance. Okay, bit unusual, but sometimes happens. Now, moving on then to the efficiency variance, we're going to compare the actual quantity, which is the actual number of hours, with the standard hours, and put into monetary terms at the standard price. Now, just like with the materials, we have two out of those three pieces of information. We have the actual quantity of hours, 49,000, and we have the standard price of €8. So what I need is the standard quantity. And the standard quantity is, given the fact that 48,000 units were made, how many hours should it have taken? Well, the maths aren't too difficult. It should take 1 hour per unit. So what I'll do is, I will put that in. 48,000 units by 1 hour, 48,000 hours. So we're going to compare that with the 49,000 hours at €8, which gives me a total variance of 8,000 adverse. For the labour efficiency variance, the labour rate variance was nil, so the overall total labour variance should be 8,000. Now if I go and have a look at that, I can see there it is there, 8,000 adverse, and what I can see here, that's made up of a nil labour rate variance and an 8,000 labour efficiency variance, 8,000 adverse. So finally we're going to look at the variable overheads. So if I just turn over there, now with the variable overheads, we're going to have a variable overhead expenditure variance, and it is basically a price variance. So with the price variance, what I'm looking for here is, well, as we have with the other price variances, we're going to have the actual price, the standard price, and the actual quantity. Remember now, we're now talking about variable overheads, and we mentioned earlier, variable overheads vary with labour hours. Let's just have a quick look at that. Variable overhead. The variable overhead, well, it takes 1 hour, because they vary directly in line with the labour hours, 1 hour to produce a tin of paint, and the total cost there is $150. So the variable overhead rate per hour, standard, is $150. Actual number of hours is the labour hours, 49,000. So what that means is 75,000 was paid out to buy 49,000 variable overhead hours. So back here then, pop that in. The actual price for variable overhead works out at 1.5306122245. Now what I would do is I'd recommend leaving that in your calculator. Now we have the standard price of 150, so I'll take minus 150, get that figure and multiply it by the 49,000 hours. So if I do that, it works out at 1,500 evenly, and it's an adverse variance. Now the little point here is that when you're doing calculations and you have a lot of decimal numbers in the middle of a calculation, you're better off not rounding, because this number here in this case is added by a number in the tens of thousands, could be in another question in the hundreds of thousands. So don't round until the end of your calculation, and then at the end you get to this point here, then you can round. So there's my variable overhead expenditure variance. Now what I need is my variable overhead efficiency variance. Well, variable overheads vary with labour hours, so this is going to be very similar to the labour hours. The only thing that's going to be different is the price will be based on the variable overhead price, standard price. Of course, we have that at 150. Now, if we just go back here, we can see we have here the calculations for the variable overheads, the labour efficiency variance, and we have actual number of hours 49,000, standard number of hours 48,000. So it's going to be the exact same here. So what I do is I'm going to work out here the standard, because it takes 1 hour to make it. So exact same as with the labor. 48,000 units were produced. It should take 1 hour to produce a unit, so that's 48,000 hours. Actual quantity was 49,000 hours, and the standard price for variable overheads is 150, so that's 1500 adverse. Because 1500 adverse plus the 1500 adverse gives a total of 3000 as an adverse variable overhead variance, which is of course what we were looking for. Okay, that's the 3 variances done, 3 sets of variances done. So moving on now to the final thing, which is the reconciliation. So if I just go straight back to the question, to the requirements, we can see we've done A, we've done all of B, and now C. Prepare a statement reconciling the original budgeted profit with the actual profit. And we're going to do this using all the variances. The original budgeted profit we can read from the table. The actual profit we can read it from our table anyway, our budget control table, and we're going to use the variances. So we'll just list down the variances. An adverse variance would reduce profit, so we'll take it away. A favorable variance would boost profit, so we would add it on. So if I just go look at my table here, you can see we have these two here. That's a sales price variance as a sales margin. They're my 2 sales variances. So have those divided. We don't divide, in this question anyway, the fixed overhead variances, and we have the subdivision for these 2. Now, in setting this up, what I'm going to do is I'm going to group my 2 sales variances together. I'm going to group my, well, we're now 6 variable cost variances, and then finally I'll have my fixed overhead cost variances. So, setting that up, what I'll have here is my operating statement reconciling the original budgeted profit to the actual profit. So I'm going to put in my budgeted profit, and then I'm going to put in my 2 sales variances. Sales price variance and a sales volume variance. Volume or sales contribution variance. And then I'm going to have my variable overhead cost variances of material price, material usage. Labor rate variance, labor efficiency variance. Variable overhead variance, variable overhead expenditure variance, and the variable overhead efficiency variance. And then the fixed overhead expenditure variance. So as I say, when I start off my budgeted profit, I will add on favorable variances, take away adverse variances, and what I should end up with is my actual profit figure. Now what I'm going to do is I'm going to go back and put in all the information that I already have into this reconciliation. Now do remember when I'm jumping back and forward that you can pause, rewind, or play at any stage. So if I just go here, I can see there's the original budgeted profit, 300,000, and that's the figure I want to reconcile it to, the actual profit. So, popping in the original budgeted profit, we have 300,000. The sales price variance was 4,000 favorable, so I'll put that in there, and the sales volume variance was 16,000 adverse, so I'll put that in there. So it's going to be 300,000 plus 4,000 minus 16,000 gives me 288,000. Now that's coming from those 2 variants there, come from the table we had. Now all the calculations I've just done, I'm going to put in my material price variance and my material usage variance. The total variance, if you remember, was 12,300 adverse, made up of the price variance of 7,300 adverse, which we put in there, and the usage variance of 5,000 adverse. Then I move on to my labour calculations. The labour rate variance was nil. Remember, we expect to pay €8 and we did pay €8, so that's nil. And the labour efficiency variance was 8,000 adverse. It took 1,000 hours longer to produce the goods than we would have expected. Then, moving on to the variable overheads, we have a 1,500 expenditure variance adverse and a 1,500 efficiency variance also adverse. And then the fixed overhead expenditure variance, well, I'll just go back to the table for a second here. That's that figure there. So we don't subdivide that, we have that information from the table, so we're going to pop that in, 5,000 favourable. Now, what I'm going to do is I'm going to take all these here, and I'm going to add them up and bring out the net variance. Well, actually, they're all adverse except for the favourable. So what I'm going to do is I'm going to end up with a net adverse variance, and the figure I end up with is actually 18,300 adverse. Now that's adverse, so I'm going to take this figure here, which is the profit after adjusting for the sales price and sales volume variance, and I'm going to subtract 18,300 from it because it is a adverse cost variance, and that will give me a figure of 269,700, which in fact is the actual profit. So I'm pretty certain now I'm right. Of course, the issue is that just because it reconciles doesn't mean you're definitely right, even though the fair chance you probably are. But if it doesn't reconcile, you've definitely gone wrong somewhere. Okay, so that is a question covered. Standard costing and variance analysis, the Bright Paint Company question and solution. And remember, this question and other questions are available on my website, danielkingaccounting.wordpress.com. Thank you very much.